Hello everyone, welcome to the 112th episode of me learning how to trade in Forex. So in the last episode we went through 5 things you must have in your trading journal. So for the trading journals you record everything you feel and do before the trade, during the trade and after the trade has been completed. So what to write down your trading journal for traders, that means recording who you are and your motivations for Forex trading, market views and philosophy, observations of the market, trading up mistakes and missed opportunities, and performance statistics. Although it's a lot, but the more detail you put in, the better it is in the long term. The bare minimum 5 things you must keep in your trading journal: potential trading area, entry trigger, position size, trade management rules, and trade retrospective. So with regards to that, the trading journal, it's your trading journal, so add what else you might need in there, or what you think you might need in there, what you need in there, what you want in there, that sort of thing, because the trading journal is meant to be for you and you only. So now we're on to potential trading area. So potential trading area. Date is the 21st. So potential trading area. You need to have a valid reason for every trade you enter. So need to have a valid reason for every trade you enter. This is also known as logic or rationale. True? You are not a caveman, nor are you a gambler, right? Why are you looking at this area to enter? Where are you looking to pull the trigger? This plan is determined by whatever setup detection method you have written in your trading plan. An example might be the crossover of 2 moving averages or price hitting resistance on a Fibonacci retracement level. Your potential trading area stands between the current price and your entry trigger. The trading area is it called entry or your trading area? The trading area is determined by whatever setup detection method you have in your trading plan. An example might be the crossover of 2 moving averages or price hitting resistance on Fibonacci retracement level. Your potential trading area stands between the current price and your entry trigger. Your potential trading area stands between the current price and your entry trigger. We strongly suggest you take a screenshot of your chart showing this area. Take a screenshot of your chart showing this area. Oh, right, and then put that into your trading diary. I gotcha. Try to make a habit of taking screenshots of your charts. Right, so potential trading area stands between the current price and entry price. Take a screenshot of the chart showing this area. Why is it not? Take a screenshot of your chart showing this area. Try to make it a habit taking screenshots of your chart. When it's time to review your trades later, having the ability to see what happened visually will help train your eyes to see possible opportunities or traps to avoid on your charts in real time. True, this will help you remember the reasons why you entered the trade or make you realize some things that you may have overlooked. The potential trade area is where you believe you will have an edge, that your trade will have a that you trade with a high probability of success and that reward risk ratio is in your favor. The potential trade area is where you believe you will have an edge, that you trade with a high probability of success. So basically you're coming out with a winning trade. The potential trading area is where you believe you will have an edge, that you trade with a high probability of success, and that the reward slash risk ratio is in your favor. You must determine for yourself how you want to meet this requirement. When you sat down in your chair in front of your screen, you were ready to trade. The potential trading area is where you can aim. This will keep you from entering a trade without a plan and shooting from the hip. Entry trigger. The entry trigger, so let me just make a new thing. So entry trigger. The entry trigger tells you when to fire. Your entry trigger tells you that once you're in the potential trade area, when to actually enter the trade. Your entry trigger tells you that once you're in the potential trade area, when to actually enter the trade. Your entry trigger tells you that once you're in the potential trade area, when to actually enter the trade. This is your specific entry technique. Now that you've decided on where you're looking to enter a trade, now you have to decide how to actually enter the trade. Do you just blindly enter? If you want to cross the street, do you simply start just walking across? Only if you want to possibly get run over. Of course, if you look both ways to make sure it's safe. The same approach also applies, it's also practical with trading. You want to make sure it is safe to enter the market, i.e. high probability trade setup. So this is your specific entry technique. The entry technique will help keep you out of trades that aren't behaving the way you would expect in your potential trade area. The entry technique will help keep you out of trades that aren't behaving the way you would expect in your potential trade area. Let's pretend your potential trade area is where bearish divergence is present. Right? Do you just automatically short, or do you wait for the price to trade near a significant resistance level first? Maybe even wait for an exhaustion reversal candlestick, a shooting starter form. Instead of waiting, you short now, and then watch the price climb higher to get stopped out. Just because you find a good area to trade doesn't mean you should just jump right in. Just because you find a good area to trade doesn't mean you should just jump right in. A good entry technique provides that solid confirmation to help keep you out of losing trades. A good entry technique provides that. Why has it just gone up to the top? Solid confirmation to help keep you out of losing trades. Again, make a screenshot of your chart and label where your entry trigger is. Make a screenshot of the charts and label where your entry trigger is. Don't forget that you must combine a good entry trigger with a good potential trade area. You must combine a good entry trigger with a good trading area, or good potential trade area. A moving average crossover may be a popular entry technique, but if you don't factor in the area in which you're thinking of entering, you'll probably be whipsawed to death. Using an entry trigger as a standalone technique is a recipe for disaster. Make sure you're aware of your surroundings as well. Don't bring a knife to a gunfight. Make sure it's safe to enter the market. High probability trade setup. I.e. a high probability trade setup. Let's pretend your potential trade area is where bearish divergence is present. So entry trigger. A good entry tech. So how you would enter the trade. Is there a correct answer for how you would enter a trade? So for example, in this situation, as they said, bearish divergence. So let me just see what it looks like again. Regular bearish divergence. The price is making higher highs, but the oscillator is making lower lows. Normally occurs at the end of an uptrend. So that means after a bearish divergence, the price looks like it's going to go down. So do you just automatically short, or do you wait for the price to trade near a significant resistance level first? Or maybe even wait for an exhaustion reversal candlestick like a shooting starter form. But which one is the right answer for this scenario though? And how would you find out if it's the right answer? Because one might work for one time, but then for another time it might not work. So I guess that would be like a thing to write down in your trading journal. So I've automatically shorted this time, but after the trade is completed, or no, after I entered, during the trade the price kept soaring until I got stopped out. So in the after I've completed the trades, I should have waited for a confirmation that the price was actually going to go down, and then enter the trade instead of just automatically going straight in without waiting for a confirmation. So that's probably what you write, and then next time you learn your lesson, don't automatically go in, wait for a confirmation that it's actually going to go down, the price is actually going to go down, and then enter then. That's what I'm getting at from this entry triggers. Wait, have we done dollar? So I don't bring enough. Yeah, okay. Position sizing. Position sizing. How big should your position be? This is the easy one. You must decide based on your risk management rules and your forex trading plan what your position size is. You must decide based on your risk management plan or risk management rules what your position size will be. In your trading plan, what your position size will be. This allows you to know your maximum risk. This allows you to know your maximum risk. Allows you to know your maximum risk. How much are you willing to risk per trade? 1%, 2%, 5%, 10%, 20%? Or are you going to bet the farm? Yeah, that's right, do it, bet the farm. No, silly, don't bet the farm. Dude, where does your farm go? Haven't you been paying attention? You want to become a trader, not a gambler. And unless you're really a farmer, you probably don't even own a farm anyway. Position sizing is important because it helps your account stay healthy and ready for the next opportunity. So position sizing helps your account stay healthy for the next trades. It is important to take note of how big or small you're trading. Take note in your trading journal how big or small you're trading. By keeping track of position size in your journal, you can see whether you are comfortable trading large position sizes, or if you prefer smaller lot sizes while using wider stops. Luckily for you, we have a gift. In our tools section, we have a position size calculator to help you do the maths and find the right number of units you should be trading. Sweet, eh? Very nice. Okay. Trade management rules. You need to have a game plan in place before you even consider getting in the trade. Get in the trade. That game plan tells you how you will manage this trade, whether it goes for you or against you. The game plan tells you how you will manage the trade, whether it goes for you or against you. You must have a trade management plan in place before you even consider getting in the trade. The trade management plan tells you how you will manage the trade, whether it goes with you or against you. Entering a trade is the easy part. It's exiting a trade where you determine whether you'll make or lose money. Be like Tom. Two traders, Tom and Jerry, could take the same trade but have two totally different outcomes. Tom will make money on the trade because he properly managed his trade and planned an exit for different scenarios. Even if he loses, he'll know when to stop the bleeding and get out with a smaller loss. Jerry, on the other hand, does not have a plan in place. He does not know what he's going to do if the price goes drastically against him, eventually wiping out his account. It's critical to determine how you will manage the trade before you enter the trade. You do not want to be making critical decisions in the heat of the battle. When you enter a trade, you should have already decided how you'll react to every possible outcome. Every possible outcome. Try and figure out all the possible variations that could occur before and decide beforehand what you'll do. So try to figure out all the possible variations that could occur beforehand, and decide beforehand before entering the trade what you will do. Surely it's only two scenarios, right? Like, you either make a profit or you lose or you make a loss. So how you want to be cold-hearted, emotionless execution robot when in the trades. Be like Spock. You want to be a cold-hearted, emotionless execution robot when in a trade. You want to be like Spock, but without his human side. You want to be a Vulcan trader. All decisions are made before a trade. You are proactive. This means you are not yet in a trade. When deciding to enter a trade, you simply refer to what you wrote here. This eliminates any seat of the pants decision making. If you do take the trade, you already know where your initial stop loss is placed. Where your profit targets are, if you'll trade or stop, where you might get out of your trade early, etc. If you do take the trade, you already know where your initial stop loss will be placed, where your profit targets are, if you will trail your stop, where you might get out of your trades early, etc. Be like Keanu Reeves. Pretend you're Keanu Reeves. If you are to given a pop quiz at any point in time during the trade and are asked, what if the price does this or that? What if the price goes here to or here? What do you do? What do you do? You should be able to answer in a snap without thinking for every single trade, every single time. What if the price does this or that? What if the price rises? What if the price falls? What if the price goes here or there? What do you do? What do you do? You should be able to answer in a snap without thinking for every single trade, every single time. You must have your trade management rules fully planned out ahead of time before the trade is initiated. You never ever want to be thinking, what the hell do I do now when in the trade? The time to decide such things is always, always, always before you ever enter a trade, yo. Word? Yep. So, basically, once you're in a trade, you pretty much know exactly what's going to... No. You don't know exactly what's going to happen, but whatever is going to happen, you know exactly how to respond to that. Like, exactly. No questions asked. Boom, this happens. Boom, I do this. Boom, this happens. Boom, I do that. That's it. No thinking, just follow the rules. Trade retrospective. Being retrospective means to take a look back at events that have already taken place. Being retrospective means looking back at the events which have already taken place. Once you've finished trading, it might be tempting to call up your homies to hit up happy hour, kick back shots of Patron, and splurge on bottles of Perignon. Dom Perignon. Dom Perignon. Dom Perignon? I don't know what that is. But it's crucial that you review how your trade went, win or lose. Once you've finished trading, it's crucial that you review how your trade went, regardless of winning or losing. You want to look back over the whole process to understand what you did right and wrong. Look back over the whole process to understand what you did right and wrong. Here are some questions to ask yourself. My trade really sucked. Oh, how well did your trade work out? Questions to ask yourself regarding how well your trade worked out. Was the position size sufficient to match the risk and reward scenarios, or was it too large, too small? Was the position size sufficient to match the risk and reward scenarios, or was it too large or small? Could you have entered at a better level? Could you have entered at a better level? Entered at a better level. What tools might you have used to improve your entry timing? What tools might you used to improve your entry timing? Were you patient enough, or did you rush in thinking you never have a chance again? Were you patient enough, or did you rush in? Was your take profit realistic or a pie in the sky? Did the market pay any respect to your choice of take profit levels, such as stopping short of it, or did prices blow right through it? Did the market pay any respect to your choice of take profit levels? Such as stopping short of it, or did prices blow right through it? Did the market pay any respect to your choice of stop loss levels, such as stopping short of it, or did prices blow right through it? So same as a profit, but with the stop loss. Did the market pay any respect to your choice of stop loss levels, such as stopping short of it, or did prices blow right through it? What news or event catalysts caused the market to move the way it did? What news or event catalysts caused the market to move the way it did? Event catalysts caused the market to move the way it did. Use the answers to refine your position size, entry level, and order placement going forwards. Use the answers to refine your position size, entry level, and order placement going forward. How well did you manage the trade after it was open? Were you able to effectively monitor the market while your trade was active? If so, how? If not, why not? The answer to these questions will reveal a lot about how much time and dedication you're able to devote to your trading. Questions to ask yourself regarding how well did you manage the trade after it was open? Were you able to effectively monitor the market while your trade was active? Were you able to effectively monitor the market while your trade was open? Or while your trade was active? If so, how? If not, why not? If so, how? If not, why not? The answers to these questions will reveal a lot about how much time and dedication you're able to devote to your trading. Did you modify your trade plan along the way? Modify your trade plan along the way. Is that just basically asking, did you actually stick to your trade plan that you've made? Which you are meant to. Did you adjust your stop loss order to protect profits? Adjust your stop loss order to protect profits. Did you take partial profit at all? Did you close out your trade based on your trading plan, or did the market surprise you somehow? Out the trade based on your trading plan, or did the market surprise you somehow? Based on your answers, you'll learn what role your emotions may have played and how disciplined of a trader you are. Use the answers to learn what role your emotions may have played and how disciplined of a trader you are. While you may want to vent your thoughts, emotions and feelings to your homies, it's better to write them down here. You are probably boring them to death anyway, they don't want to hear your whining. What can you improve and what specific steps will you take for improvement? Questions to ask. I just realised this is ASL, not ASK. To ask. Questions to ask. Where was yourself regarding what is what can you improve and what specific steps will you take for improvement? This is your opportunity for trader self-improvement. Do not just write vague confessions like I need to hold my winners longer, or I need to cut my losses quicker, or I need to be more disciplined. These are totally useless by themselves. Identify specific steps that you will take to improve. Identify specific steps that you will take to improve. How will you hold your winners longer? Hold your winners longer. So that just means how can you make more profit from that trade? Or yeah, is that what it means? How will you hold your trade winners longer? How will you work on choosing a better profit target? Will you work on choosing a better profit target? How will you hold your winners longer? Will you learn how to not freak out at the first sign of your unrealized profits falling? Will you learn how to not freak out at the first sign of your unrealized profits falling? Oh, that's going to be hard, I reckon that is. Because, like, as a newbie trader, when you first see, like, your trade's going well, and then it just, drops down. You're like, oh my god. Like, it's a bit, heart shaking. But anyways, there are no right or wrong answers in this review process. Just be as honest with yourself as you can be. And be specific. Be honest with the answers. Otherwise you won't improve as a Forex trader. Did you execute your trade according to your trading plan? Do not take this. Wait. Did you execute your trade according to your trading plan? An important question. Did you execute your trade according to the trading plan. According to your trading plan. According to your trading plan. Do not take this question lightly. Do not take this question lightly. If you are not routinely executing trades according to your plan, then you either have a serious problem of self-discipline or there is a problem with your trading plan. If you are not routinely executing trades according to your trading plan, if you are not routinely executing trades according to your trading plan, then you either have a serious problem with self-discipline, or that's what self-discipline, or there is a problem with your trading plan. Either way, you have a big problem that needs to be fixed yesterday. If the answer is no, wait, so let me just write that in the another line. So if the answer is no, this is a big problem which needs to be fixed ASAP. If the answer is no, did you execute your trades according to your trading plan? If the answer is no, this is the big problem which needs to be fixed ASAP. Okay, I'm going to leave this episode here then. So in the next video, we're going to go through trading performance statistics. There's a lot of data stuff going on, but yeah. So thank you all for watching, and I will see you guys in the next video. Peace.